In today's economic landscape, there's never a dull moment. And with recent developments from the FOMC and Jerome Powell's eyebrow-raising statements, it's clear that the U.S. economy is headed for some exciting times. Today we will take a deeper look into what's really going on. You might think assets like bonds are the boring side of finance. But if 2023 has taught us anything, it's to expect the unexpected. We're witnessing daily seismic shifts in bond markets. Yet, curiously, bond spreads haven't quite hit that recession warning level. However, prepare for some game-changing info set to release. Now, the Bureau of Economic Analysis recently provides annual updates on key economic metrics, namely the GDP and GDI. Ideally, these two figures should mirror each other, but the current situation? Far from it. The buzz is real, and you won't want to miss it. Morgan Stanley just dropped a note hinting at a potential economic downturn in the fourth quarter of this year. 2023 might end on quite a cliffhanger. And while we're on the topic of staying updated, if Invest Growth Wisdom's content is adding value to your financial knowledge, do consider subscribing. It goes a long way in supporting our channel. Now, back to the crux. Post the September FOMC meeting, Jerome Powell's remarks threw the financial world into a whirlwind of speculations. And the chaos wasn't unwarranted. He delivered some rather perplexing statements, catching even seasoned investors off balance. There was one particular exchange that stood out. An unexpected response to a Reuters journalist sent shockwaves across the market. It was probably the catalyst for the spike in short-term interest rates. Here is a recap of the conversation.
Different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible. And I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me.
Interestingly, even though the FOMC decided to keep the overnight rate at 5.5%, there's a subtle hint that they want us to think of this as the new normal, a stable high. But can we really trust this promise? Confidence in the Federal Reserve isn't at its best. The bond market reflects this lack of trust. For the Fed's plans to work as they hope, the market reactions need to line up. However, recent changes have been, to say it plainly, hard to predict. Just 6 months back, people were optimistic about a soft landing, but Powell's recent words show a change in the story. Now, what's causing this hesitancy? Lending activities. Conversations with credit establishments and the subsequent data echo a shared sentiment. Lending is sluggish, almost stagnant. Historical data indicates a pattern. Whenever banks constrict their lending norms, a recession isn't far behind. This might not be immediately obvious in the chart I'm referring to, but those gray areas? They indicate times when the economy is in a recession. A steep climb on this chart signifies a period of robust loan activities, easy times to secure financing for your endeavors. But now, it feels like we're on the edge of a cliff, and historically, after such moments, the economy tends to take a dive into a recession. Spooky, isn't it? And it's not just about the tightening, it's the sequence of events. Remember the early 2000s and the 2008 financial crisis? We've witnessed this scenario before. Another term that finance folks might be cautious about is revisions. For those not deeply involved, think of revisions as updated versions of financial stories. The word on the street is that significant revisions are looming. Back in 2007, before the Great Recession, there was a similar buzz. Everyone was optimistic, brushing off the possibility of a downturn. But then, revisions came in, and the financial landscape underwent a transformation. Last week, the Bureau of Economic Analysis released revisions to two crucial metrics for the first quarter of 2023. GDP, gross domestic product, was revised up from 2% to 2.2%, and its lesser-known counterpart, GDI, gross domestic income, was revised to 0.5% from previously -1.8%. While GDP represents the total market value of products and services, GDI provides a snapshot of the total income. Ideally, these two should move in sync, like synchronized swimmers. However, recently, they seem to be dancing to different tunes. After the revision, the two figures moved closer, but the gap between them is still at a historical high. So far, the U.S. economy has held up well in the Fed's interest rate cycle, but many investors see cracks are showing up here and there. Bill Ackman, billionaire investor, recently commented that the level of real interest rates is high enough to slow things down.
Issues, presidential election, you've been talking a lot about how you want Jamie Dimon to run. Jamie's not going to run, I don't think, but
I've given up on that, yes.
You've given up on that?
Yes.
But you're giving money to Vivek Ramaswamy?
I did.
Chris Christie?
I did.
You giving money to Biden?
No.
No. So what do you want to happen here?
I want an alternative to the choices we have now. And I think the country would be very well served.
With the choices that you don't want any of the people
No. I think a Biden-Trump election is not good for the country. I'd love for there to be a candidate the entire country can get behind, as opposed to this, two-sided world that we live in.
Who do you like the most? Of all the people, you know the options.
Well, I don't know them all.
But I mean, you know of the options.
I've not met Nikki Haley. I'm going to have an opportunity to do that soon. I met with Chris Christie recently, and I was actually really impressed. A real guy, super solid, governor, did, I think, a very good job dealing with the hand he was dealt in New Jersey. Was able to get elected in a Democratic state. I could see him as someone to bring the country together. Will he have the widespread appeal he needs in order to rise? I think, an early test will be New Hampshire.
Final question. You met with Zelensky.
Yes.
I think you're a supporter of Ukraine.
Yeah.
I think
yes. Big supporter.
Would have you liked the U.S. government this weekend to have funded Ukraine? And by the way, how does that square with Elon Musk, who I know has a very different opinion of Zelensky, I think?
I don't know that Musk has a negative opinion of Zelensky. I think his view is that a forever war in Ukraine is not good for America, is not good for Ukraine, not good for anyone. I agree with that. I'd like to see a world in which that war ends. It's a black swan risk for the world. There are thousands of young people and innocent people dying. I'd like to see a world where that ends sooner rather than later.
Okay.
So, as we conclude this video, if you found value in this exploration, please show your support by giving this video a thumbs up. And if you're eager to continue growing with us, hit that subscribe button and become part of our journey into the realm of economic insights, growth strategies, and investment wisdom.